Well, greetings everyone, and welcome to the Argonaut monthly video covering February 2024. February was another strong month for equity markets, with European markets up 2% and global markets up 4%. It was a quiet month for macro data, with an absence of central bank meetings. However, there was yet more evidence that the nominal economic boom in the United States is continuing despite high interest rates. January saw the most jobs created in 12 months, with non-farm payrolls at plus 353,000 net new jobs versus only 185,000 expected. US inflation is also proving stickier than forecast, with January CPI up 3.1%, core CPI up 3.9%, and core PPI up 2%, all higher than expected, though this was shrugged off by the market as owing to one-off January effects. We came into this year with the market hoping for interest rate cuts from the Federal Reserve. But actually, Fed fund futures have now gone from pricing in 6.5 quarter point interest rate cuts starting in March at the start of the year to just 3.5 starting in June. All of this suggests that the nominal boom supporting corporate earnings and credit can endure, but at the costs of higher for longer interest rates. The Argonaut Absolute Return Fund made plus 4% in February, making positive returns in its long book and losing money in its short book. For more details on how we did this, please refer to our February monthly fact sheet. Recently, there has been a lot of attention on the performance of the so-called Magnificent Seven stocks in the US: Microsoft, Apple, Alphabet, Amazon, Nvidia, Meta, and Tesla. These companies together now have a market value of $13 trillion, which is 1/4 of the US market and roughly the same size as all European stock markets, including the UK, combined. Now, it might be easy to dismiss the share price performance of the Magnificent Seven as an investment bubble, until we consider that they are forecast to make over a combined $400 billion of net profit this year, up from $85 billion a decade ago. The average share price return from the Magnificent Seven of 2,686%, that's 27 times in dollar terms, over the last decade, is predominantly explained by the average earnings per share growth of 1,769%, or 18 times since 2014, which has also been helped by the fact that the companies have bought back a lot of shares. Contrast the Magnificent Seven with the 5 biggest FTSE companies in the UK, but also constitute 1/4 of the UK stock market: Shell, AstraZeneca, HSBC, Unilever, and BP. Together, these companies have grown their net profits in dollar terms by only 20% over a decade, and earnings per share by an average of just 34%, explaining the more modest average 65% increase in share price since 2014. Whilst the US has the Magnificent Seven, it seems that the UK has only the unfortunate 5. Across many industries, American companies dominate because they have been generally laser-focused on profit. By contrast, Unilever fought a marketing campaign to prove the moral worth of Hellmann's mayonnaise, whilst our oil and gas companies have long since become cowed by climate change activists, deciding presumably as an act of penitence to diversify into low-value alternative energy projects with disastrous consequences for shareholder returns on capital. Some will, of course, argue that America simply has a bigger technology industry, but there's nothing preordained about this. the Magnificent Seven companies were on average founded just 30 years ago, in 1994, with Tesla in 2003 and Meta in 2004 founded this century. By contrast, the average age of the unfortunate five is now 115 years old, circa 1909. What does this say about the environment for private enterprise in the UK? If you had invested £1 in the FTSE All-Share Index a decade ago, you would currently have 64 pence of profit, including dividends. But that same £1 invested in the S&P 500, the most representative index of American stocks, over the same time, would have made you a profit of £3.38. That's over 5 times your money. Share prices, believe it or not, tend to follow or even anticipate shareholder profits. Whereas the earnings per share of the FTSE All-Share have grown by 47% in sterling terms over the last decade, those of the S&P 500 have risen by a whopping 156% in sterling terms. This alone explains the divergence in investment returns between the UK and the US. The real reason that the FTSE is failing is that the UK PLC, along with the rest of Western Europe, has turned its back on capitalism. The basic fiduciary duty of company management to maximise profit for shareholders has been replaced by the need to appease all stakeholders. Now, like many bad ideas, environmental, social, and governance, so-called ESG regulation, originated in Brussels, with the onerous imposition of reporting requirements on publicly traded companies, as well as investment funds, on their compliance with the low-carbon, so-called sustainable economy, in addition to eliminating historic discrimination and incorporating any other trendy issue of the day. How management ever gets round to thinking about generating a profit is not clear. Don't be fooled by the inclusion of governance in ESG, since this is not inclusive of traditional concepts of governance, such as whether the management are stealing from shareholders or cooking the books. It focuses instead on adherence to the woke political agenda. Rather embarrassingly, nearly every high-profile corporate blow-up of recent times has occurred with the rogue company having the highest ESG ratings. Accountability to shareholders has been displaced by a need to manage different interest groups. Consequently, the boards of our PLCs end up being accountable to no one, able to indulge their own pet social and environmental projects paid for with somebody else's money. ESG has spawned a bull market, not in stocks, but in mindless bureaucracy. Small companies won't go private due to the reporting requirements, whilst profitable old economy companies will go private. It hasn't yet occurred to the UK government not to follow the EU down the same disastrous path. Our government has recently shown a revived appetite to compete with companies and investors in allocating capital. Although the historic track record of state industrial policy in picking winners is patchy, the record of loser companies requiring endless taxpayer support picking government is exemplary. The logical endgame of ESG is, however, even worse than state industrial policy. It involves not just government, but all public capital being allocated, not primarily for profit, but according to the political values of organisations which are not democratically accountable. This seems to me a bit like communism. As the economist Milton Friedman pointed out, the responsibility of business is to make as much money as possible within the rules of society. Those rules should be set by a democratic parliament, not unaccountable, unproductive green grifters. We have forgotten that profit has been the greatest motivation known to mankind to allocate finite resources productively. That capitalism is inherently meritocratic because its survival instincts require the best talent and optimal resources, and that no society can have sustainable economic growth without profit growth that increases the capital base of the economy for future productive reinvestment. In short, without profit, you cannot have sustainable economic growth. And without economic growth, society falls apart. Profit is therefore intrinsically good. The pursuit of profit ensures a Darwinian survival of the best economic ideas. As the infamous fictional corporate raider Gordon Gekko succinctly put it in the 1987 movie Wall Street, the point is, ladies and gentlemen, greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms, greed for life, money, love, knowledge, has marked the upward surge of mankind. And it is the pursuit of profit, to paraphrase Gekko, that will save not only the Footsie, but that other malfunctioning corporation called the UK. Thank you.